Welcome to the latest in the IMAP series of webinars around managed accounts. Today, my name is Toby Potter and I chair IMAP. But today is a really important webinar. They're all important, of course, but today is one of the ones that I've been particularly looking forward to. Today, we're really asking ourselves the question, have managed accounts made a difference through these times? Like, if there was ever a time when managed accounts should have come into their own, this is it. We've been through a period of substantial market volatility. We've been through a period, we are living through a period when it's probably difficult for advisors to be in face-to-face contact with their clients. We're living through a period when clients and advisors are subject to all sorts of uncertainties that little can prepare us for. So managed accounts are one of the fundamental ways in which advice services are provided to retail clients. So if there's ever going to be a time when they come into their own, this is it. And today we're really lucky to be joined by a number of practitioners to talk about how managed accounts have worked in their practice. So moderating today is Jonathan Bayes, consultant with Maze Road Portfolios, but previously Chief Investment Officer and Head of Wealth for Prime Financial, a finalist in the IMAP Licensees Managed Account Awards. Piers, Bolger, Chief Investment Officer for Viridian Financial. Viridian was last year's Licensee of the Year for IMAP, in IMAP's Managed Account Awards. And is responsible for a substantial team of advisors and portfolio managers. And Silva from BetaShares. Many of you will know that BetaShares, through their ETFs and through their portfolio building services, are closely involved in the development of managed account services. Cham is responsible for the portfolio management function within BetaShares. So I'm really looking forward to three practitioners talking about how managed accounts have made a difference. Before I hand over to Jono to moderate today's discussion, just a little about the rest of this year. Like everybody else, we're somewhat in flux. Currently judging the awards, and we will have the winners announced on the 27th of August. We had hoped to have a live awards ceremony. I think that's looking increasingly unlikely, even though we're in Sydney. Investec, our technology conference for the 10th of September. We've been extremely lucky to have Brett Ebedes, formerly General Manager with Iris, work with us in putting Investec together. And Investec is really where we try to draw together the threads of technology and how it's transforming advice businesses with a particular regard to managed accounts. 10th of September. And then the 10th in Sydney, 16th in Perth, 18th in Melbourne for the portfolio management conferences. Again, we'll be focusing there on asset allocation, manager selection, security selection, the way in which portfolios have been managed. So I'm really looking forward to November and the portfolio management conferences. And of course, each month, at least one webinar. Coming up next month, we'll have a focus on ESG portfolios and a webinar focusing on some of the technology issues. If you'd like to ask a question, at the bottom of your screen, or perhaps at the top, depending on how your screen is configured, you'll find a Q&A button. Type your question in there. All of the panelists will see that question and deal with it as we go through the session. So without further ado, it's my pleasure now to hand over to Jono Bayes to take us through today's panel discussion and presentation on how have managed accounts made a difference. Jono, thanks very much. Over to you.
Thanks, Toby. As we were discussing earlier, I've got the easy job, I think, today, and Piers and Chamath have got maybe a slightly harder job to detail their experience with managed accounts and how it compares with the advisor implemented portfolios. Perhaps it's a good time just to start by having Piers and Cham introduce themselves and explain their businesses and how managed accounts fit in contextually within the businesses, and then we can go from there. Maybe hand it over to yourself first, Piers.
Thanks, Jono, and hi everyone. So as Toby said, I'm the Chief Investment Officer here at Viridian Advisory. And within Viridian Advisory, we offer a range of managed account portfolios under Infinity Asset Management, which is effectively the investment management arm of the broader Viridian business. We've been offering managed account portfolios now for over 3.5 years. The business started back in September of 2015, and by the time we sort of got all the approvals process and got all of that underway, as I said, the portfolio has now been up and running for just under 4 years now. So, the core of our business is private wealth advisory. We also have direct engagement with external AFSLs holders as well, just depending upon their requirements as it relates to the managed account portfolios. Broad investment team, upwards of over 20 people across our business.
And Piers, can you just give us a bit of detail on the nature of the managed accounts that you're running, whether they're asset class or risk profile bucketed? I think that's good context.
Yeah, we run 13 managed account portfolios, so quite a number. We run 2 long-only direct equity portfolios, one sort of a core top 100 ASX portfolio, and then we run a small to mid-cap, which is effectively X50 all the way down to, by and large, ASX 250 by market cap. So those portfolios now have been running since June of 2016, so just ticking up to 4 years. Relatively concentrated portfolios, roughly around about sort of 20 to 25 stocks. We've found that advisors quite like concentrated portfolios when they do the look through on behalf of clients. So as I said, in the stock universe, we keep it relatively punchy in that instance. And then we have 6 multi-asset portfolios, so following a broad-based approach to the way that we provide risk profiling across our client base. And then we run 7 individual sector-based portfolios, so covering off on the major asset classes, so Australian equities, global equities, property and infrastructure, alternatives, diversified fixed income and the like. So we run those portfolios. As I said, they're all discrete, so the sector portfolios don't feed into the multi-asset portfolios, albeit that we could have an overlap on potentially on some of the underlying investment managers or strategies.
I presume that the asset class portfolios feed up into the risk managed accounts, the risk profile managed accounts. Is that fair?
Yeah. Well, one of the things when we set the business up, and we obviously had quite a, we had a high level of experience within our advisor network at the time. And one of the elements associated with that, and one of the aspects that we think is nuanced, certainly in the way that we think about managed accounts, an advisor could go into a more holistic, balanced configuration, let's say, which is, with the asset allocation managed by the investment team. But clients might equally only want Aussie equities direct, and then they might want exposure, let's say, into global equities and fixed income. And so the sector portfolios allow the advisor to have that conversation with clients. It allows them to be able to tailor that portfolio in the context of getting that asset allocation right. And as we know, asset allocation represents, anywhere of, 75 or plus % of an investment return. So the focus then from our point of view for, on behalf of the advisor as well as the client particularly, is the ability to make sure that the underlying components that fit, those portfolios are working as they should. And then clearly, if we're making changes, we're just thinking about the global equities as an example, or fixed income, you're changing between duration and credit. you're able to do that, you know, without the advisor having to contact the client, write an ROA, etc. So the ability to provide that functional change, whether or not, as I said, be within the portfolio or across asset classes, enables us to do that on behalf of the advisors and the clients, and that works really well. So that's why we sort of separated that out. So you make a good point there, Jono. In order for advisors to still have that tailoring and have that overlay in terms of the conversation with the client, in terms of, you know, where they want to position their portfolio more broadly, within that we can then shape that accordingly and provide that input and expertise.
Yeah, great. Charm, perhaps give us an understanding for BetaShares and how you guys work with managed accounts yourself.
Yeah, for sure. And thanks everyone for joining the webinar, and thanks Jono and Toby. So at BetaShares, we offer exchange traded funds across all the major asset classes, and we currently have 62 ETFs, and we currently manage just over $12 billion. We also manage an array of ETF model portfolio estimates that are available on all the major platforms. You know, in relation to my role, I'm responsible for the fixed income portfolio management, as well as the fixed income product development. And I also sit on the BetaShares investment committee. Gotcha.
And so I've got to ask, actually, and this is a question without notice, Charm, but in the role of portfolio manager on the fixed income side, so what are the primary responsibilities that you've got in that regard?
Yeah, so just on the day-to-day role, it's all about, you know, for the most part, managing tracking error against the indices we track, and I'm primarily responsible for our index tracking fixed income ETFs.
Gotcha. Perfect. So, I mean, again, as Toby intimated, and I guess everybody on the call is probably agrees with, you know, the volatility we've had in markets over the last 3 or 4 or 5 months, and I'd probably argue we'll see rear its head again in the remainder of the year, has been a really fertile ground, I would have thought, for seeing the benefits of managed accounts for client portfolios. So just wondering what your experiences, Piers and Charm, have been in recent months, and the things that maybe you take away when you compare how clients have experienced, or what clients have experienced within the managed account framework compared to, say, the advisor implemented portfolios, whether they've behaved and worked in the manner that you thought, or whether you've found additional benefits perhaps from managed accounts or problems. Just interested in the experience that both of you guys have had through what's been, you know, pretty unprecedented volatility.
Yeah, no, well, absolutely the case there, Jono, and probably just from our end, just give you a couple of examples on how it's sort of tracked across our business. And I think first and foremost, one of the biggest advantages that we've seen, certainly both in discussion with advisors as well as, you know, equally some clients, has been the ability to rebalance portfolios. And, you know, one of the challenges that certainly we saw in the industry, and one of the reasons why we went down this route, and equally as we've grown the business, new advisors coming in, they quite often have quite divergent portfolios across every client. And when I say divergent, it might not necessarily be so much in terms of asset allocation, but it might be underlying product selection that varies. And so the consistency in that framework is challenged in this particular types of market environments, where either the ability to rebalance or the ability to be able to get across your clients, just given the speed of what we saw in terms of market declines through February and March, can be really challenging. So in the context of the managed account portfolios, what's worked really well and the way we've managed that from an engagement point of view has been our ability to rebalance the portfolios, make changes to the portfolios we thought that was appropriate, and then be able to communicate that succinctly and quickly to advisors and ultimately to clients. And the feedback that we've got from clients around this is, you know, really, you know, a lot of them have said back, it's really comforting to know that, you know, the advisor is being proactive, even though the advisor is really just providing that relationship side of it. but knowing that it is being managed, as I said, either it be just a rebalance back to what the strategy looked like, given the sell-off that we've seen. And so the second aspect also around that, it means that a lot of that emotive element that gets the clients often experience in significant market moves, whether it be up or down, but clearly, downward moves often create that more negative feeling that, the world's about to end, I've got to get out. And as we know, clearly we didn't know what, 23rd of March, it certainly looked like things were going to get a lot worse. Fed steps in, and since then we've seen a significant snapback in equity markets. Now, you can all argue as to whether or not that's warranted or not, given what we're seeing in the real economy. But equally, many clients, I think, would have run to cash or sold out of their equity positions, as we know, at the bottom of the market. And the ability just to be able to stand back and not get caught up in that emotive element potentially to the same way that a client would, we think has also been really beneficial. And again, we've had numerous conversations both with advisors and their clients around, I would have made that decision to sell everything and I would have locked it in, and not knowing when to get back into the market. And so you then have that sort of FOMO of regret that they've made the wrong call on 2 occasions. So from our perspective, that's been a really positive outcome in terms of the overall management of client portfolios, their expectations, and how to have conversations with them through, as you say, really challenging times. So the construct of the managed accounts has worked really well because it's helped the administration side of it. It's helped the ability for clients to be able to understand what investing is and should be like in the context of individual strategies, and that's been a positive we've found.
Just a follow-up, just interested in also to the process, because the one thing that I found with it all was just, 9 times out of 10, the implemented portfolios might be okay because the markets don't move as quickly as they do. But then when you get such, rapid moves in particularly in the asset class relativities, as we saw in the first quarter, the ability to react quickly is vital. I'm sure that would have been a positive for you guys, but can you just fill us in on your investment committee process and how you guys might have been quick to implement change during that volatility, Piers? Sorry for a question without notice.
No, that's fine, Jono. So we have a daily meeting. The core portfolio management team. There's 5 of us in that team. We have a daily meeting at 10, and that's not so much a decision-making meeting, but it's more around what have people read over the last 24 hours? What are they doing? What are they focusing on? Just again, it's more conversational, just for people to obviously get a temperature check on how people are thinking. Again, I think that's really important. Everyone has different perspectives, and can bring a lot to the table. So we don't operate on being a silo that one person controls the outcome, etc. So we certainly try and have that team-based approach in the way that we look at investment management. And then we have a more formal weekly review of all the portfolios. Now, clearly certainly through the latter stages of February through the entirety of March, we might have had maybe an extra have an extra couple of those meetings through the course of the week, particularly given when we start to see credit spreads start to move out, not so much even on investment grade, but you even saw treasury spreads move out from 4 to 70 basis points. So for us, that was a signal that, clearly we were seeing some potentially quite significant dislocation come into markets before the Fed really stepped into the breach effectively and calmed that down. So, through that period, we were having, as I said, quite significant conversations internally. It enabled us to be able to then either reposition at a strategy level or at an asset allocation level in the context of our portfolios. And, alongside that, we also then had a weekly Zoom conference call with all the advisors just to let them know how we were thinking, what was happening in the marketplace, how we were interpreting that, as it related to the portfolios and the strategy. And the final aspect associated with it, given the fact that the portfolios in and themselves, I mean, one of the advantages, we have a relatively tight and concentrated list of managers that we work with in terms of the portfolio. So we were able to really spend a lot of time having conversations with those guys as well, and they were very open and transparent. So we were able to get to, what I would say a quicker level of understanding as to what they were doing within their portfolios. Were they increasing their cash? Were they looking at it as an opportunity to buy? And that also enabled us to then also bring that information back into our overall portfolio management framework. So I think in the context of all of that, when you then, we didn't have to worry about that emotive element with clients. If you were then trying to do that, then worry about the emotive element with clients, and then potentially put something in writing to a client, it would have been extremely difficult, that's what we saw, with a lot of advisors, particularly those that were struggling with that element with clients. They to some extent were a little bit rabbits in a headlight. So for them, it was a light bulb moment, more often than not, as to the value that we were able to bring to clients in that sense.
I found too, I mean, in some ways during those sort of volatile moments, it's nice, and some agree with me or disagree, but sometimes it's nicer for the advisors to put a little bit of space between the investment decision making and the client. It means that they can, not do it irresponsibly, but to effectively let go a bit of responsibility to an investment committee, which sometimes in those sorts of periods of volatility really reduces a bit of the implicit pressure maybe that advisors sometimes feel when they're talking to clients.
Yeah, I think that's really, really true. And I think that they can play a little bit of devil's advocate as it relates back to what we're doing to the client. And that just helps that, either the ongoing relationship that they have with the client, but it also ensures that the client is understanding that the advisor is absolutely acting on behalf of the client and trying to make sure that the client is getting the outcomes that they're wanting to achieve, through time. So, I couldn't agree more with you on that. And I think the other aspect that we found as a business, certainly through, particularly through the most recent periods, but over long term, the ability for the advisor to bring in, other people within the business that are, subject matter experts. It could be through insurance. It could be as it relates to this on the investment side of things. So clients then actually see that it isn't just the advisor that they're dealing with. They're dealing with the entirety of the business. Yeah. And people within that business have specialist skills that are working on behalf of the advisor for the client. And again, we found that a lot of clients really valued that. And the ability, we spend a lot of time on calls with clients. We're very happy to do that. And they really sort of saw the value in what was going on. And particularly, as I said, as related to the managed accounts, because they were feeling that this is happening, you're doing something, I don't have to worry as much. And, that was a great level of comfort for a lot of clients.
Yeah. No, I completely agree with all that. Charm, sorry about that. We'd love to hear what you guys saw, particularly as a major provider of some of the strategies that are going into managed accounts, what you guys have seen and observed through what was a really volatile couple of months.
Yeah, for sure. And I'd just like to say that, Piers, has demonstrated how, practitioners can use managed accounts to successfully navigate such a turbulent period. But at the end of the day, it's this managed account environment in combination with the ETF implementation vehicle, in combination with available ETF options that give advisors and asset allocators the control to choose their desired exposures, whether it's strategic, whether it's tactical, whether it's core, whether it's satellite, in a very dynamic and timely way. And if you don't mind, I might just, illustrate, one example. So the visual that I have up on the screen is just a very simple macro framework that's, based around Bridgewater's approach to macro asset allocation. And within the managed account environment and with ETFs, you can express any of these exposures depending on your view towards, say, growth and inflation. And I think that's the key point, that no longer are you limited to that binary choice between risk assets and passive assets. Now there's a whole range of exposures where you can finesse your greater degree and manage accounts value or the trigger on that exposure in a very home way. And in terms of our exposures, we have a lot of these exposures already available in ETF form. So whether you are constructive on risk assets, you can decide whether or not to allocate towards risk assets that are from a disinflationary environment or an inflationary environment. You go with, let's say, the NASDAQ 100. Say you want to play the secular trend continuing, or you think we might get a reflationary impulse and, you might fancy global banks or global energy companies. On the defensive side, you're no longer limited to, say, cash or just, say, the broad investment grade bond market, but you can finesse it. So you can even allocate to defensive exposures that might benefit from still a pickup in inflation expectations. So you can play that stagflationary environment via gold or other types of real asset exposures, or you can play this the traditional or deflation or recession protection via government bonds.
And I mean, were there any notable themes or trends that you saw during the months in terms of advisor activity, Cham?
Yeah, so during the month, I'll just highlight some examples. So one very popular vehicle was
your audio is just a bit average, Cham. I don't know whether you want to sit back or sit closer. I suspect probably sitting back, but it's been muffled on a couple of occasions.
Okay, is that better by any
That's
chance? Good. Okay, all right, let's go with this. All right, so say our short products have been a popular vehicle to either express, let's say, a bearish view of the market or just to protect existing long exposures. Another popular option was gold. We personally believe that in having exposure, so clients can get the return.
It's breaking up again, Cham. We didn't get any of that.
Right. Okay, sorry, can you hear me?
That's good.
Technical. Yeah, sorry, the mic's playing up on my end. Yeah, another vehicle that was very popular was our hedged gold product. And this allows us to get the US dollar return to gold, hedging out the US dollar currency. And in our view, the environments that are really suited to gold to coincide with the leaders. Fed on the margin is more accommodative banks.
Okay, we missed a lot at the end there, unfortunately, Cham. So I might pass over to Piers because it's a nice natural segue while you get your microphone working into a couple of practical examples. Piers, the things that you guys did that were either saved your bacon or made really good alpha on moving the portfolios around.
Yeah, well, I suppose part of, if we just go back to sort of December of last year, so we ran within, if I just talk about our core balance strategy, we were running a more growth orientated position across our portfolios. We felt the global economy looked good, inflation wasn't an issue, cash rates were set to remain low. So we felt that 2020 was going to be a good year for risk assets. And so we positioned our portfolios accordingly around that. So, and that worked okay in the context of January. But, clearly through, as things started to worsen and, we moved into a lockdown. So our ability to reposition the portfolio, as I said, we were able to have those meetings internally, and we took some of that risk off the table, to be frank, and repositioned it both in terms of our bond positioning, and we were able to do that before spreads really started to move out. So that was beneficial to us as well. And then through the back end, really that early part of April, we started to again take some of that repositioning of the cash and put put that back to work. We didn't put it all back to work. You know, in hindsight, we probably should have. But we started to put that back to work through April and May. So end result was that we've had a very strong June quarter, and our March quarter was down, but nowhere near as probably what it could have been had we maintained that positioning that we thought of through the back end of 2019. So if you then think about that in the context, and I think this is, again, going back to why we think that it's been advantageous for our clients, has been the ability for us to make those changes across over, we've got over 1,200 clients across our managed account portfolio. So if you think about that's on average, 20 ROAs per advisor plus the time, etc. To get back, they probably would have not made any changes. And so I think that when we look at that in the context of, what we've been able to do, now whether or not hindsight, I still might have made the wrong decision, but I think the ability for us to be able to engage and provide that assistance, I think, has been really, really positive.
Well, it's again a neat segue into the next question about the benefits of managed accounts relative to the advisor and blended portfolios. And so the ROA process, which we all know can be quite onerous, is one, and speed to market. But are there other again client biases we've spoken of? What are the other ones that sort of leap out at you, Piers? And maybe communication's one that I've found. What do you guys do in terms of your communication with clients on the managed accounts? But I know it's a wide question, but just to give us a bit of a guide for the things that you find really provide you relief from the managed accounts in terms of not only your job but also to the client experience.
Yeah, and probably just touching base on your last point there, Jono, around sort of clients sort of driving outcomes, or advice being client-led. Again, I think that's a really good point you make, because quite often, again, in emotional market environments, clients say, well, why haven't you done this? Why aren't we doing this? All those sorts of things. And again, human nature, people can go, okay, I'll implement that. And that might be just because to try and placate the client without it necessarily being well thought through in the construct of what the client really is trying to achieve longer term. And I think that, again, the ability for us to avoid that and to work with advisors around having those sounding board conversations really important, because it, again, avoids clients making ad hoc decisions they might hear down the golf club, read in the newspaper, see in the press, etc. So I think that's a really positive point you make on that front, just to help on that side of it. Look, in terms of communication, we do a couple of things, and we've instigated them more readily. So we normally do a monthly end of month market call to the network, and we record that, and that then goes out to clients as well. We started to do that on a weekly basis certainly through Feb and March. So it just enabled that constant contact coming through, so clients again could at least hear what we were saying, whether they agree with it or whether it turned out to be correct. But it was just the ability for them to have that contact back into the business. Our monthly reports, so we do a lot of reports on the performance of the portfolios, how we construct the strategy, how we're thinking, and those sorts of things. Again, that's all written from the perspective of the client, so they're not necessarily war and peace types of documents. They're there to be sort of 3 pages. You're trying to get the clarity of the point across and the view so the client can digest it. And then, obviously what we, do just more broadly in terms of some of our more thematic market research. So again, we wrote a number of papers through that period in terms of our thinking around asset allocation, our thoughts in terms of, what the lockdowns would mean, implications for the economy, implications for financial markets. And we wrote, 3 or 4 pieces around that. And again, depending upon the market environment, we would always write at least, 2 or 3 pieces a quarter. And then finally, our capital markets, which is, clearly probably a little bit more heavy reading, but, how we were thinking about, our forward look on forward assumptions on asset class returns and risk, particularly given that we were certainly seeing in the listed market that many corporates were simply just, dropping guidance altogether. So the context of, what did that then mean on the earnings outlook? How would that then potentially flow through into asset classes and the like? From our point of view, it required us to, potentially at least just revisit what our capital market assumptions were like, because this could be, something that, at that stage, from our point of view, have a very, very material impact on what the forward-looking analysis would be, and then, what would that then mean for asset allocation and the like. So that was sort of the engagement model that we had through that period. As I said, a lot of it's a continuum, but we probably upped the ante a little bit just in terms of some of that context, just given obviously what we were seeing, and just the the extent of what we're seeing both domestically and globally. Are you on mute there, John?
I've got to unmute myself. Yeah, we'll come to round it out in a minute with how you're feeling about things and some of the changes that you've made to models and to assumptions. But maybe before we do that, Cham, I guess as someone who's providing a lot of the tools to advisors in how they build their managed accounts, what have been some of the benefits that you've seen comparing the managed accounts to the advisor implemented experience, and maybe using, again, recent months as a guide?
Yeah, sorry, we just had a last-minute microphone switch, so hopefully things are a bit better. So Piers mentioned, just the ability to, say, switch between duration and credit instruments. That's one example that, we strongly believe in. We, just using fixed income, we believe in, disaggregating the bond market, because we know that duration and credit can behave very differently and can interact very differently with equity portfolios. So advisors made use of. They've, let's say they've gone into credit, started to behave, in a bit of a dislocated way, especially in the middle of March, or they, went more towards, say, longer or ultra long duration government bonds. If they wanted to maintain, let's say, a bearish or a downbeat view on the macro environment.
Yeah, I think that I mean, again, it's another thing with the managed accounts, and it probably plays in well with what you've done, Piers. But sometimes, these are really nuanced decisions that need to be made, and the average advisor's strength largely lies in the long-term strategic portfolio construction, the client relationship, and maybe not to denigrate the skill set, but duration calls or the like aren't necessarily the first place that an advisor's head is at when you get markets jumping around the manner that they are, and yet they're very, very important in terms of generating performance. So, I mean, where are you sitting now, Piers? I'm sure everyone's fascinated, given your team have managed the crisis, I guess, if you will, really well. And where are you guys sitting now? What have you done within your managed accounts coming out the other side? I mean, you touched on the fact that you've added risk through April and May. Are there any particular things that you're looking for in the next couple of months that might allow you to tweak your managed account setup one way or the other?
Yeah, so thanks for putting up that slide, Jono. So I don't know if that makes a lot of sense to everyone, but I mean, just sort of the asset allocation of the portfolios through time. So probably a couple of points to note. Again, we're remain of the view at a house level that asset allocation is still the most important and most significant driver in terms of sort of portfolio outcomes through time. So you can see there that the changes are nuanced, but in the context of the way that we then look to build out individual strategies within, say, fixed income, you might sort of see some quite more significant changes there. So that's been one area, even though we've been actually reducing our fixed income position. Within our fixed income position, certainly over the last couple of months, we've been quite happy to add to our credit positioning within that. So as we know, spreads moved out both in high yield investment grade and equally obviously on the treasury side. So we really added quite aggressively to our credit positioning during that period. particularly, as I said, once the Fed sort of stepped up to the plate. So we felt that that was a little bit of a free kick. And we continue to believe that to be the case somewhat. We haven't seen spreads move back to where they were sort of in the early part of the year. So we're still comfortable in that positioning, as I said, more in the IG rather than sort of the high yield part of the market. Equally, we're happy to add to, we had an overweight position to global versus Australian equities. We rebalanced that back towards more Australian equities. And again, that's worked for us. Both have gone up, but again, our thinking probably until more recently, Australia was through the worst of COVID and the lockdown, and we were likely to come out, at least from a real economy side of things, a bit more quicker than what we're seeing in offshore markets, and that was going to be beneficial to Australian equities. And by and large, we've seen that obviously until Paul Vic's been back into lockdown. So, we certainly were happy to add to our equity side of our portfolios on the back of what we were seeing in terms of central banks and the desire by markets. Now, again, rightly or wrongly, but the desire by markets to look through, the challenges that we're looking at the moment and saying, well, what's the growth outcome look like through the second half or latter part of 2020 into 2021? And with the extent of the stimulus packages coming in a fiscal sense, as well as what central banks are prepared to do, we certainly felt that was going to be positive for risk assets. Now, the timing of that is always an unknown, and at the moment we're quite happy probably to be in the larger cap rather than the smaller cap side of things, and underweight EM as well. But we feel that potentially at some stage that valuations and opportunities present. So it's just about how we operated within asset classes as opposed to, holistically. We've certainly added into real assets as well. Again, we quite like the longer duration theme associated with those assets. We understand there's clearly some pricing risk, but that's been another area where we've added to, and ultimately the funding vehicle for most of that has been our cash position that we built up, as well as some tweakings within the asset classes. So that's how we're positioned. The portfolios, as I said, by and large, that's worked successfully for us through the second quarter, particularly. Going forward, we think that we're going to be probably in a more protracted growth slowdown. So, the recovery phase that I think everyone thought was most likely going to come through the third and fourth quarters of this year, we think that that's probably maybe not going to come at the same speed as what was originally thought. So it does provide the opportunity, in our view, just to be able to fine tune those positions. But where we're seeing the long end of the curve and the like, we're not expecting some big moves again in yield, in spreads. So, we've still got a bias towards growth assets. We've just got to understand the risk that we're putting into the portfolios if the markets do have another sell down, and our ability to be able to manage that accordingly. But the value of diversity, I think, has really come to the fore. If you look at the performance of financial markets over the 12 months, I mean, cash and fixed income, Aussie and global, and credit have been positive performers. Other risk assets have all been negative outside global equities, believe it or not. But again, that's been a case of two halves, as opposed to being a consistent outperformer through 2020. So, again, we've got a lot of asset classes, and we think diversity does help. It does have a role to play, as long as you don't sort of take it to the nth degree and try and get too cute.
Yep. Well, guys, thank you for that. We've got a few questions that have come through, and I'll throw them out there, and basically, Cham or Piers, if you feel like you want to take them, feel free to do so. One of the questions is suggesting that many of the benefits mentioned so far are largely about being able to rebalance the portfolios. How is this different from running a multi-asset managed fund? Surely Russell and the like would be rebalancing their portfolios in managed funds just as quickly. I would say absolutely that's the case, and in many respects, Piers, yourself and people like myself are doing that very role, and very similar to what you would get in a multi-asset managed fund. I guess you get a bit of transparency within your accounts and other managed accounts. Is there anything you would add to that?
No, I think that's absolutely fair, Jono. I think the other point probably is, beneficial ownership isn't at a unit trust level, but we bench ourselves against peers in the marketplace, and you need to be doing that if to ensure that obviously your relative position from a BI point of view is appropriate. So you're spot on. Russell are one of those managers that you bench against. In that context.
No, completely. Here's the question through, just wondering, and this might be one for you again, Piers. Do you have a volatility forecast as part of your portfolio management process?
We do, absolutely. Our core thesis around that is that we think volatility is slightly more stable than our forecast on returns. And generally, we're out, on our work that we've done, we've found that to be the case. But certainly, it's an important part of our modelling process. So one aspect that we look at is obviously the return side of it, but clearly you've got to marry that up with your volatility forecast, and that sort of helps, as I said, our modelling framework in regards to asset allocation positioning, and then ultimately into strategy selection. So we can update those forecasts, every day if we wanted to, but clearly it doesn't make a hell of a lot of sense. We formally look at it every month, and then, as I said, we capture that in a quarterly thematic piece of work that we do.
And this is one for both of you in your experience, in what you've experienced. But do you feel like you've traded, or in your instance, Cham, what you've seen, do you feel like there's been more trading in the portfolios over the last couple of months?
Look, I think among our investors, there definitely has been. We've seen a surge in ETF volumes overall, especially in the areas of global equities. There's been a lot of flows into, say, our NASDAQ 100 ETFs, as well as, I guess, more thematic plays. For example, global energy has received strong inflows, especially around the gyrations in oil, especially during April. But we've also seen, a lot of flows into areas like healthcare and tech more generally, which is seen as, almost safe havens at the margin, just within, while the pandemic's still in focus.
I saw today actually the most consensus long position I think that Merrill's have had in their fund manager survey now is US technology. I don't know if you saw that, Piers.
Well, certainly tech and healthcare have been the big winners, but and we can, from our point of view, if you looked even domestically, you can see that as well. So a company like Next, obviously, we sort of view it more as infrastructure, but we think the way that we don't think people are just going to go back to Westfield shopping malls like they did previously, and so you're seeing that just in terms of the conversations that you're having with landlords and the turnover that you're seeing of foot traffic and the like. So e-commerce, in our view, is a game changer now, and we think that will continue to grow as people become more comfortable with it, and on the context of just what businesses are doing around their e-commerce strategy. We've seen Temple and Webster go through the moon. A lot of that obviously through e-commerce, as well as obviously the product side. So I think the tech side of it in some instances is absolutely very real, and healthcare as well. ResMed has been a particular beneficiary on the ventilating side of it in the US, and we think that those types of businesses, and clearly when you look at energy, tourism and leisure, we know airlines and the like, it isn't that all businesses and all industry segments have been hit negatively, and consumer staples another benefit, and we've seen that through Woolies and Coles, etc. So we've seen a lot of examples in our view where the market has changed, consumer behaviour and patterns have changed. Now, whether or not that'll be complete structural shift, time will tell. We think potentially in some instances it will be, and therefore that will result in different market dynamics. And again, to your point that some of these sectors that people view as expensive, may not be that expensive as we move forward and have some level of normality reoccur, whatever that looks like.
Hey, Cham, we've got a question specifically for you, actually, mate. No pressure. But the question is, what's the benefit of using the fixed income component, ETFs? Is credit and duration versus the composite or an active manager? So I'm not sure. What's the benefit of using the fixed income component ETFs? Is credit and duration versus the composite or an active manager?
Well, I guess at a high level, just starting with the composite is liability weighted. So the exposure is given to you based on the issuer's behavior. And, you know,
Right.
we believe that issuers shouldn't really set your exposure.
Yep.
What you need to get out of fixed income really depends on what you want to get out of fixed income and, you know, what your portfolio needs. And, you know, maybe you don't need, 50% in Commonwealth government securities or 25% in state government securities. Maybe you want more corporate exposure than the composite offers.
Right.
Just on active managers, I think one of the big hurdles that active managers are facing right now is that we are, I guess, in a low expected return environment and a low real return environment. So the idea of paying, say, the median management fee of 60, 70 basis points, that really is a big hurdle, to start off with and to overcome. And that management fee is a much larger part of expected total returns going forward than it has been in the past. And that's why we are seeing, a lot of flows globally, especially out of active fixed income and into passive vehicles.
Yeah, gotcha. I think it's two last questions here. One, does the lessons of the 1987 crash, or can they be applied to what we're going through now? I'm going to leave that one for the panelists to answer.
Well, look, I think you always learn from history. You're a fool if you don't. And so, I think that there's definitely, component parts that you can take in terms of any market correction or any market environment. In our view, we haven't seen anything like this in the context of social and economic upheaval since, really the Second World War, and none of us have lived through a pandemic.
Yeah.
So the challenge is, where we go from here, and there's just, it's just too difficult to tell at this stage. So we do look at history, but I think that, it is a very fluid environment. And if we all went back to normal, as an example, in the next 3 months, let's say, in the whole world, and we found a cure for coronavirus, we think markets would go on a massive tear.
Yeah.
I don't think that's going to be the case. But then the challenge will be, how do central banks and governments then, claw back all that stimulus? So it's just a real challenge. But I think that look at it. But I think we are in a new or very different environment to a more traditional market correction, which is driven by, let's say, valuations going super stretched, or parts of the industry segment, like financials that we saw in 08, just becoming an absolute bubble and fraud in many instances. This is very different.
Yep. Yeah, no, agreed. And the last question, have the direct security portfolios been managed differently from the managed fund or the ETF portfolios? I guess that's, again, probably one for yourself, Piers, although Cham, you might have some remarks on your experience relative to advisors. I'll leave that. Maybe again, it's you, Piers, to start with. Just very quickly,
yeah. Look, we have, and I think part of that, if you look through, as I said, a lot of corporates were coming out. So the smart corporates, so take Qantas. We haven't owned Qantas, but take some of the smart corporates. What they did early on was come to the market and raise capital. So that's sort of base case corporate 101 management in really dire market regimes, that you look to raise capital, shore up your balance sheet, particularly if you're in an industry segment such as the airlines, which were clearly under the pump and continue to be. So where we saw industry segments that were looking to raise capital, the question was, why are they raising capital?
Yeah.
And was it for balance sheet? Was it for maintain covenants, debt covenants, and the like, all those sorts of things. So we certainly look very closely at that. But then you saw businesses like TCL, so Transurban is an example, a company that we like really long duration concession assets in point. Volume traffic just fell off a cliff other than trucks.
Yeah.
But TCL's had a nice little rally through, as people have had to holiday at home and the like. Volumes are still nowhere near where they were previously. But there was a company that we, as I said, we averaged back into. We didn't hit the bottom. Clearly, we just didn't know where that was be, but we averaged back into that position. So, our turnover was a little higher. It was more around protecting capital as best we could, focusing on industries and segments where we saw, you know, quality in the product, quality in the cash flow, and they could survive. So, you know, Woolies, Wesfarmers, these types of businesses that we felt that we're going to you know, continue on, and you know, we've been happy to add to our materials position as well. Just given what we've been seeing in Brazil, you know, by and large, we've been playing that through, diversified through BHP. So the short answer is yes, we certainly have been probably making changes, not necessarily wholesale stock changes, but certainly new positions within the portfolios, yes.
Yeah, gotcha. I'm conscious of time, so Toby, feel free to chime in if you like. I mean, there's one other question there, or do you want? Should we address that privately?
Yeah, that's fine. Look, thank you very much, Jono, and thank you very much everybody who's attended today. In particular, Jono, Cham, and Piers as our presenters. What we've had is a really excellent overview of the way in which a well-developed, well-managed advice business uses managed accounts and the depth of thinking that goes into it. One of the questions which was interesting to me from the audience was, well, why wouldn't you just use a multi-asset class fund? And I think Piers has shown, and Cham through their work with advice businesses, that the capacity to manage portfolios as close as possible to the clients and having regard to the type of client base that an individual practice might have and the attitudes and orientation of individual clients, the capacity to include securities that clients identify with, such as Transurban, or as Piers mentioned, gives a colour to the use of managed accounts. So that was as good an articulation as I think we've heard about the benefits. So thank you very much for participating, everybody. As I mentioned, our next webinar will focus on ESG, one of the byproducts of the turmoil of these markets. Has been an increasing focus, for better or worse, on ESG as a consideration in portfolio construction. AMP and Pengana, Pendle and Pengana will be participating in that webinar on the 4th of August, and we look forward to you joining us there. So Jono, Cham, Piers, thanks very much. And
thanks,
thank
Toby.
You very much.
Thanks, Jono. Thanks, everyone.